Today I'm joined by Joe Curtis, Manager of the City of London Investment Trust. Thank you, Joe, for joining me. Well, how would you characterise the investment style of your fund?
Well, I manage the fund of what I call a value and income style, in that I believe that share price valuation is the key determinant in your future returns. So I'm really looking at a range of means of valuing shares, of which dividend yield is the most important. And then the second part of the philosophy is really income, and that, as I say, dividend yield is very important for share price valuation. I'm also seeking to deliver consistent dividend growth and above average yield for the investors in the fund. So it's a sort of combination of value and income. And I think it leads you toward conservative companies. I mean, conservative companies are best able to pay sustained dividends, in my opinion.
And you've got a tremendous record. I think the share price return over 5 years is 99.5%. And in terms of dividend growth, you've got 48 consecutive years of dividend growth.
I mean, the 48-year record, we are helped enormously by the investment trust structure. So on the one hand, we've invested in solid, stable companies overall, make the odd mistake, but overall the portfolio's been, in good companies. But secondly, we are able to, in the good years, retain income up to 15%, and that helps us smooth the payment through the more difficult years for the economy and the stock market.
Currently, in terms of the macroeconomic environment, are we on a sticky wicket, or is it the pitch in good condition?
Well, I think the market's now slightly ignoring some of the positives. I mean, the screaming headlines of the oil prices falling. Well, that's, apart from oil producers, that's actually very good news for the rest of us. And I mean, my view is that the market is overlooking some of the positives in the economy. I think the economy's in a lot better shape than it has been. The banking system's a lot stronger, and we have had some reasonable years of growth, and employment is much higher and unemployment lower. So and inflation stayed low, below 2%.
And are you seeing much value out there in terms of companies? Yes,
I think the market overall is yielding about 3.5% on a historic trading basis. That's a dividend yield. Our shares, our City of London, are yielding around 4% at the moment. And when you look back into the financial crisis, when in the years 2009, 2010, something like 25% of FTSE 350 companies cut or passed their dividends. I mean, the environment's a lot healthier now. We're seeing much better dividend growth across the market. And of course, that's the sort of first thing I start with. There's a range of other considerations I'm looking at as well.
And have you established any new positions recently?
Well, I've built a bit in the turbulence in the autumn. I added a bit to my existing positions, but a couple of interesting new stocks I bought over the summer. One was Taylor Wimpey, the house builder. I think this is a good period for the house builders. The housing market, the fact that it may be levelling off a bit, I think is a positive. I mean, the fact is the UK is short of homes, particularly in the southeast of the country, and Taylor Wimpey's got a land bank of over 5 years of strategic land which is acquired at a very attractive level, and I think we're in a good period for a leading house builder like Taylor Wimpey, and they've also indicated to investors quite a generous shareholder distribution policy in terms of special dividends. So that's one I'm positive about. And the other one is ITV, the television company. Had been many years ago, ITV was a sort of collection of regional companies, and it all merged into ITV, and it's finally coming good. And I think obviously ITV is helped by advertising. It also requires good programming skills, and they're increasingly selling their programs like Downton Abbey all over the world.
I know that a lot of investors will watch this and try to pick up tips. So I wanted to ask you, in terms of any book that you could recommend for an ordinary investor to help educate them.
Well, I think the classic book, which I would recommend, is The Intelligent Investor by Benjamin Graham. He was, in many respects, the founder of security analysis and of value investing. He worked in the United States and in the wake of the great Wall Street crash. It's a very readable book, and I couldn't recommend it more highly to people, if you want to get an understanding of investment. I think it's one of those classics that's timeless.
No, I've read that book. It's a great book. No, that's a great recommendation. And I think in terms of the pitfalls that you, both as a fund manager and any investor, faces, what's the worst mistake you've made, really?
My own mistakes, I suppose. I think the banking financial crisis, I was underweight relative to market averages, and I didn't have any of the smaller banks that caused problems. But with the benefit of hindsight, obviously the leverage of the banks going into the crisis was far too high, and all the danger signals were there. And although I was underweight in the area and in the better banks like HSBC, which did relatively well, I'm nevertheless, it's a regret to me that I didn't sort of see it a bit more clearly.
But it hasn't put you off completely investing in banks, as I think you hold a couple.
There are times when banking can be very profitable, but by its nature, because the banks are very leveraged and they're kind of running their businesses on a kind of narrow, although it's huge amounts of money, but the actual amount of equity supporting their business is bigger than it was, but it's still quite low. That by their nature, they're sort of prone to disappointments when the economic cycle turns sour. But that doesn't mean to say there's some very good franchises out there and some good managements, and you can make a lot of money in banks during periods of this economic cycle.
And are you comfortable with the results of the bank stress tests?
Yes, I think the UK banks come out quite well for that, and the leverage ratios, which were also announced, are comfortable with the leading banks. So I think the sector's in a lot better shape than it was. The financial crisis was also partly a failure of regulation, and I think they've learned that the banks need higher capital ratios to operate, and that they allow things to get too weak in terms of capital ratios and too high in terms of leverage ratios.
Well, I can't ask you about possible failures without asking you about your greatest success, so I'm quite keen to hear what that was.
Well, funny enough, it's been, and you wouldn't expect it in many respects, it's been in a tobacco company. I mean, British American Tobacco has been the most successful stock in my career. It's gone up more than 10 times since 2000. It was very out of favour at that point during the technology bubble, and when it was dumped in favour of kind of stocks not only didn't pay dividend, didn't make profits, but subsequently it has shown. I mean, it really shows how value investing can work, because despite the fact that tobacco is obviously, I don't smoke myself, and is a declining industry, but it shows how a well-managed company that generates cash and pays good dividends can, when it gets oversold and gets extremely cheap, can then recover and perform very well. So it's delivered a lot of value to investors over that period. And I've taken some profits, but it's still in my top 10, and still delivering good dividend growth.
Thank you very much, Joe.
Pleasure.
Thank you.